So some analysts looking at this year's stock market rally have reminisced on their years in college, fraternity and sorority, and going to beer parties. They all had an experience of getting too sick and puking over the rails. And at the beginning of the year, that's exactly what many people did with regard to the stock market. They looked at the crash. I mean, it started out as a minor correction, but we got down to a loss in the S&P of almost 20%. Another couple of minor partial percentage points, and we would have declared bear market is upon us, run for the hills. And all of a sudden, things turned right around and went almost straight up. It turned out that the tariff news was not going to be the beginning of Armageddon after all. And we show that historically, these kinds of things have occurred before, not frequently, but gut-wrenching as it may be, it's part of being an investor. So this has been referred to the Liberation Day, and the announcement of a new world order as far as tariffs are concerned became a puke and rally. And we had a month of a collapse that we were wondering how bad is this going to get. I mean, nobody thinks that President Trump still has all his marbles. And then all of a sudden we got deals that are being announced with the UK the first, but that's a long-time trading partner, despite the fact that we became partners after we were at war with one another a couple of hundred years ago.
Just details. Yeah, details. Ignore that. Yeah.
And the real question is, what's going to happen with all these other countries? Are they going to make deals? I think the answer is yes. Even China finally, actually, the news is, made a call and said, let's meet in Switzerland, neutral territory. And the initial news was, well, we're going to lay the framework for more discussions. And 2 days later was, we have a deal. Now, it's a 90-day deal, but it's 90 days to see if China is real in their commitment to deal more fairly, more balanced in the tariff arrangement with the country. So those are the issues on our agenda today. And I'm Don Creech.
And I'm Perry Sykes, and this is the Investor Resources Podcast.
So as we're looking at the collapse of the market as a result of the introduction of new tariffs, that's one of the fastest drops in market value as far as the S&P is concerned.
Sure.
Since at least 1960, maybe going back even further than that. This is unusually rapid, so it caught a lot of people off guard. What's interesting, if you're sitting here listening to us and saying, yeah, that was me, you're not alone. What's really interesting is that news was so earth-shattering that major fund managers said, we can't ride this out. We have no idea where this is going. And they became extremely defensive, and to the limits that they can, which are pretty limited, they raised cash. And now, with the advent of some tariff resolutions, and more importantly, the major commitments of investment in U.S. industries coming into the country from foreign countries, all of a sudden the market accelerates more rapidly than it has. In fact, it's the 15th most rapid rise in the market, I think, since 1900. Goes back a long way.
And that's massive. It's huge, and it illustrates, like you said, Don, even on the professional investor side, professional money managers, in the beginning of the tariff talk, lost track. They really did lose the narrative of what was going on. And actually, they held on to the narrative and stopped looking at the facts of what was occurring. And the fear gauge went off the scales. And everybody was reacting out of fear and not out of in a state of reality and looking at, well, we know what this probably is, but the fear is so high, we cannot allow this we can't afford to wait. We have to do something right now, even if it's a mistake. turned out it was, which is why the drop was so fast and then the recovery was so fast, was so quick. It was like, well, that was pointless. But they couldn't get out of their own way. They could not stop themselves from just bailing on numerous positions because of the fear involved. Investor sentiment was in the tank, and the level of the unknown was what really spooked Wall Street. We are in uncharted territory. We don't know what to do. So as fast as we can, we're going to get as much out of the way as we can, and they did that.
Well, and now they find themselves on the wrong side of the trade.
Correct.
Because they're major money managers, mutual fund money managers in many cases. They control a lot of money, and
Yep.
You don't just pick up the phone to the trading desk and say, I need $300 million committed, or 300 billion, whatever the money is.
Right.
They will disrupt the market, so it takes time to move in and move out. And one of the things that's caused this rapid acceleration off the bottom is that there were so many institutional investors that were short the market when it started going up. They had to cover those
Right.
shorts. So that
Yep.
hopefully to avoid losses, but to at least minimize the losses, they have to buy back into the market. And here, as we approach the last week of the month, they are still basically underinvested in the market. So one of the fears that is still prevalent, particularly among independent investors, the American Association of Independent Investors historically has a 31% bearish bias. But as we wrapped up last week, they're at 45%. They are still overly bearish despite the recent rally. And that's basically the same position these big institutional money managers are in. They don't own enough stocks. So the question is, we move into a seasonally weak period of being in the market, has a ton of institutional money that needs to rotate back into equities during the summer.
Sure.
So the fear level at CNN has come up to greed among the active
Right.
traders.
Right.
It's
Like,
whipsaw.
holy smokes. Yeah, I'm missing it now, and I have to go. And that's so important for everyone to understand. Just think about what Don just talked through right there. These are institutional money managers at the highest level that got this completely wrong in the short term, completely wrong. And they were near panic selling to get out of the way because they believed in their own prediction. They believed that this is going to be awful. In fact, there's no option except for this to be absolutely terrible. And so they just bailed as quickly as they could, only to find out, well, no, actually, the opinion that we didn't really adopt, that this is all just negotiating tactics and we're going to get deals done here. And these are not tariffs being placed for the long run. These are just to initiate the negotiation to get the tariff deals done. And that's what's occurring. Oh, we got it wrong. Again, it's just another one of those indicators of how hard it is to predict what's coming up. No, you don't know. Track the data, watch what's going on. And sometimes that's very difficult, especially when the narrative gets out of control on the fear or the greed side. And we've seen both of those since the beginning of the year this year. So it's a perfect illustration of how not to get your portfolio tied in a knot based on the narratives that are being thrown around, especially the ones on television.
Well, certainly the ones on television, because their primary job is to create anxiety to support the advertising sales department. We need
Keep your eyes on the screen until the next commercial. That's their job. That's right. That's their
right.
job. Never forget that.
So now I run Fox Business all day during the day, just as background noise, and every now and then something will come up that catches my attention. I want to pay attention to, but generally, investors often think that those programs are designed to educate them. That
Right.
is not the case. That if
Not
you
even
are going
close.
to do stock research, you want to do the research with research data and some software, not the television program. Do
Right.
yourself a
Right.
favor, spend a few bucks a month on a good software program. We use tc2000.com. It's inexpensive. There are other programs. Stockcharts.com is inexpensive. Market Guide's not too bad with IBD. There's other places you can go, but if you're going to do investing on your own, you need software and you need to be able to do some committed to do some research. And that's based, even though the money managers have research teams, they got caught up in the storyline and sold when they didn't need to. Now, frankly, we made adjustments in our portfolio, but not because of the storyline, but because rates of return were changing. And as those rates of return change, it re-identifies where leadership is in the market. It also identifies where laggards are. You own something, it's no longer working. Whether you've owned it 2 weeks or 2 years, when it quits working, according to the standards you set for monitoring your portfolio, if it's not working, it doesn't belong in the portfolio.
Move on. Yep.
Because there's something else that is. Broad diversification, as Warren Buffett has said in the past, is for people who don't know what they're doing. Actual money managers, professional high frequency trading algorithms are going to rotate to strength. In order to stay in a portfolio, it must continue providing a benefit, a reason to be there. Think about that. Why do you own things that aren't working? Because you're diversified, but it's not helping you any. So let's get down.
Brokers promote that because it's easy. It's simple. Get diversified, and then all we have to do is stay on the phone and talk you into not moving your money. Whether it's best for you at that time or not, it doesn't matter. It's just a matter of keeping your money invested in our firm, not someone else's firm. And that's a public relations function, not a money management function. And that's where you have to understand that most of the time, that narrative that people are putting out is not for your benefit. It's for their benefit. And you need to keep that in mind all the time.
So you need to focus not so much on macro issues, but on the specific issues in the sectors that you, in fact, are going to invest in. And how do you get
what do
there?
You want?
We just basically described the process, and that is watch for leadership. Leadership comes either at the sector level or at the industry level, or call it a subsector industry. That is not hard to identify if you have some basic, inexpensive software and you spend a little bit of time figuring out how the software works and building your own rules. Correct. We run three individual different structures for our individual clients, and we run 5 different models for our 401k clients. They each have a set of rules. They're different rules, but you follow the rules every time. You cannot predict the market. Nobody can. Everybody has a temptation to predict the market, but that's a flip of the coin because nobody knows the future. What you do know is what has happened recently over the last week, 2 weeks, month, quarter, year, 5, 10, 20 years. Part of that's a function of your time frame and your risk management, your risk tolerance, and only you can determine what that is. But once you identify that, you set up your rules and you trade your rules. It makes it a lot easier to not get caught up in the headline euphoria or the headline panic. You don't want to be on the greed end and you don't want to be on the panic end.
Exactly. And that with the rules that we have in place, that doesn't mean every trade is a gem. That doesn't mean every decision that you make in your portfolio is profitable. It just means that the odds are now in your favor instead of the market's favor for your market trades to be on the profitable side. So that's the best you can do. Give yourself a chance to be able to make decisions based on the data and be on the good side of more trades than not. And that's about as good as it gets.
So you mentioned that not every trade is going to be profitable. The issue with bad trades is to admit they aren't working quickly and lose the least amount of money when the assumptions don't work out. And that will happen.
That's really important. Yep.
It happens to individual investors. It happens to the big guys too. You're not alone when it comes to having to face, that was a bad trade. Let's get out of here and go someplace else. Yep. Anyway, hopefully this is helpful for you. If you want to talk to us about your portfolio and what we do, whether or not it might make a difference, you got questions on the software, you can give us a call, send us an email. We'll be glad to respond. Thanks for being with us. Subscribe to our podcast. We have more coming in the days ahead.